Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today's Thursday, September 3, 2015. Looking at a daily chart of the SPY or Spider. And we had an interesting day today. So the market was spiked up early in the morning on some phony economic news or whatever the deal was. Maybe it was on that ECB release or news about them keeping rates the same. Doesn't really matter what it was. The point is that the math is what's important. So if you look here and you see this red line here at 198.07, right? Okay, what was the high today? This morning, 198.05. Okay, basically that's within the tracking error and the market was rejected and we kind of just floated lower for the rest of the day for the most part. And I'm going to bring up a intraday chart because there's a couple of things I want to point out, and then we're going to discuss what I think happens tomorrow, which is a employment number and coming out, and then into next week, and what some important dates are that we have to be aware of. And then we'll kind of try and put together the roadmap of what to expect over the next week or so. Okay, so each and every day, I'm going to try and refine the roadmap of what I believe is going to happen so that we can be aware of how to trade this thing and where we should be positioned accordingly, okay? So this is the 10-minute chart, right? So we hit this, basically this high here, came within 2 pennies of it, and the market basically sold off for the most part the rest of the day, right? So we went up in the morning and then sold off for the remainder of the day. But if you just pull back a little bit farther, and let's look at the hourly chart, and this is where we're going to get into what I think is coming. The hourly chart is, and you know what I'm going to do here, right? Because you've seen this too many times. This is a bullish pattern based on the hourly chart setting up for higher prices, okay? So, what I think today was a fade for most of the day, which gives people the false sense that the market is still kind of on shaky ground. And then what happens is, I believe that tomorrow, this is what I believe is going to happen going forward. I think tomorrow the jobs number will come out and it'll be perceived as a good number. The number, as we know, is phony. It doesn't really matter whatever they say the number is. We created X amount of jobs. The unemployment rate is 5%, 4.5%. Whatever they want to say it is, it is. It doesn't matter. We know it's not what it is, but everybody hops on the bandwagon. All the economists pretend that that's the number, and then they go with it. So the market participants will perceive the number, and what will generally happen is at 8:30 when they release the number, the market will whip around a little bit. It'll go down, it'll go up, it'll go down, and then it'll settle out. And then because it's the Friday before the Labor Day holiday weekend, the volume will generally be light. And this is really what I think is going to happen, right? Don't take this to the bank. This is what my perception is of what's going to happen tomorrow. The volume will be light, and generally speaking, on the day before Labor Day weekend holiday or any of these 3-day holiday weekends, you generally won't get a sell-off. And if you remember what I was saying for like the last week or so, I was saying, you know, this week will generally be more of a bullish week based on the seasonality trend of the week before Labor Day holiday weekend. And for the most part, that's what we've seen, right? So what I think is if you look at the hourly chart and you see how this is setting up with a bullish pattern, I could see the market moving higher tomorrow and then going into the holiday weekend. Get this one. So China was closed for the last couple of days. Okay, they made up a holiday, something about their World War II and their victory over Japan. And so they created a holiday out of thin air. This wasn't like a regular scheduled holiday. They created a holiday out of thin air. They closed the market. And the main reason why they did that, and I'm going to flip over to the China market for a second, and this is not the Shanghai, but this is the Dow Jones Shanghai Index. It tracks the Shanghai Index, but the chart is identical, right? So this is the hourly chart of the Shanghai. Now, it was closed today, and it was opened last night, but it was not open. I'm sorry, it was open the night before, and it was closed last night, and it'll be closed again tonight, and I guess it'll reopen on Monday. So get this. So let's first go to the daily chart. Okay. Now, China's been getting hammered. So I think that's why they just created a holiday out of thin air, closed the market, and said, you know what, we need a break for a while. And what they'll do is they'll come up with something when the market's open Sunday night. And again, this is just my take on what I think is going to happen, right? Don't take this to the bank, but this is what I think is the likely scenario with China. They'll come out with something where the Chinese market perceives it as good news, and China will rally on Monday while our market is closed, okay? And where do I get that from? I'm just looking at the charts, okay? All I'm saying is that the chart pattern is setting up for a bullish pattern for higher prices, okay? That's all I'm saying. So I'm saying that usually the bullish patterns get confirmed by some kind of news event after the fact, okay? So I think that China will come out with something. The market will rally when it opens back up on Monday, and then we open on Tuesday, and then our market continues a rally that probably begins tomorrow with the employment report. Let's go back to the spider. Okay, so here's the 60-minute. Let's go back to the daily, and let's try and put this thing together. Okay? I'm giving you a lot of conspiracy theory, but it's not conspiracy theory. I'm looking at the charts, and then I'm kind of assimilating data or news events that could confirm what the charts are telling me. I don't really care what the news is. I'm just telling you what the charts are telling me. So I still think there's a little more upside in this market. And as you know, I've been saying that I think the market is going to get up to this area, and I think it's going to fail at this area. Could it go higher? Of course it could go higher. It certainly can go higher. But I just have the perception that it's going to fail at this number here. So this is what I think, okay? But what I think is, so I think we rally into Tuesday and potentially some of Wednesday, but hear me out on this one. Wednesday, which is September 9th, is an important day. It's an important turn day in my cycle analysis. So keep that one in your calendar. I believe, and I didn't double check this before I started the video, so I apologize, but I believe that Wednesday is also the Fed announcement, if I'm not mistaken. I don't think it's the week after. I think it's next week, if I'm not mistaken. You'll double check me as I'm saying this or after the video, and I will too. But either way, I think that's a Fed announcement day. And if that's the case, and if we rally up into Wednesday, now get this one. Let's say the employment number is perceived good, okay? Then we rally on Tuesday. It gives the Fed cover to raise interest rates a quarter basis point, and therefore they can get off the schneid. Okay, that's what I think is going to unfold. Of course, we'll see what happens. I don't know what's going to unfold. I don't really care what unfolds, but I'm just putting together the chart patterns, the cycle dates, and what I think is coming with a scenario that makes sense to me. And I'm passing that along to you. And for fun, we're going to see how it all unfolds, and we'll see whether I'm right or wrong. But it's kind of fun to put the story together before it happens, and then we'll see what happens after the fact. So if that's the case, and the announcement day is Wednesday, in fact, I'm going to pause the video for a second, and I'm going to come back and tell you when the Fed announcement is. Okay, I was wrong about the Fed. It's the week following next week. So forget the Fed component of this. But the point is that Wednesday is an important turn day in my cycle analysis. So I believe that if, in fact, the market has the propensity to rally up into the cited levels up here, and even if it's a little higher, that's fine with me. And maybe we don't even get there. Maybe it's over here. Somewhere in this zone. It really doesn't matter. Okay? And if that's the case, then I believe that next Wednesday may mark a turning point for the market to begin some kind of a move. Okay? Now, you're not going to get Well, I don't really know, but I don't think you're going to get, 1,000-point move in the Dow on Wednesday. That's not what I'm saying. What I'm saying is that Wednesday marks an important turning point in my essentially my cycle date calendar, okay, the 9th of September. So I'm putting this together with a potential high around that day, and then here's another important day that you need to realize, understand, and write down. On the 13th of September is a solar eclipse, okay? That has a tendency to be a very important point for the markets, okay? It can be a turn and it can be an acceleration. Either way, it's very important for this point in time, okay? Now, it doesn't necessarily mean that the following day a huge event occurs in the market. It can, but what it signifies is a further turning point that's going to have an impact on the markets from that point forward. Okay, so it's not a one-day event. It tends to be an important turning period for the markets. So I'm putting all this together, and these are the pieces to the puzzle. These are these parts of the detective story that all have impact on the reasons why I believe we're in a very, very important turning point for the markets going into the next 6 to 8 weeks or so, give or take. Okay, so that's kind of my story as I know it. I'm giving you everything I have, all the pieces to the puzzle, all the tools in my toolbox that I'm using, again, with the mathematics and how I'm coming up with the targets, whether it's the high over here or whether we squeak all the way up to maybe even to 202 level, and potentially, and it's not out of the question that we could even fill the gap all the way up in this area here. Okay, that's not out of the question. I just don't think that's the highest probability scenario. All right, so that's everything I know with the markets as I see them from my seat looking forward. And from now, we're going to... what we're going to do is we're going to skip the IWM. It was consistent with this spider. It was down 16 cents today. There's nothing to see there. The VIX was still down today, and this is interesting. While the market finished down today, the spider finished down. The SPX finished up 2 points, but the spider finished down. And but the VIX was down 0.5% today. So there's really nothing to see there. I just find that interesting. The transports were up 5 points, but that's flat in terms of percentages. So there's nothing to see in the other markets. So let's move on to gold. So gold had a down day today, and frankly, I'm a little disappointed in gold. I'm not saying that the story is off the table in terms of higher prices. I just don't love the fact that it was down. Came into the moving averages, but it finished below both moving averages. I don't love it. But yet again, still, as long as we're above the $1,112 area and remain above there, and certainly we're remaining in this zone, which is a lot of support, okay, that's okay. I just don't love the fact that it was down. So there's really nothing to see here. I'm still long gold. The gold trade that I took in GLD is basically flat. And I'm watching it. If we get a significant close below 1112, I'm probably going to move out of that trade, reevaluate, and we'll see how the market reacts off that level. But for now, I'm still expecting higher prices, and there's no reason I'm going to leave that trade unless we close convincingly below $1,112. But I will tell you, I don't love the action here today in the gold complex, the gold market. But what you're going to see with the employment number, you're going to see gold whip around. You're going to see the stock market whip around. You're going to see the bond market whip around. That's part and parcel to the employment number. So, maybe it's just positioning before that number. We'll see. Don't be scared if you see gold dip below $1,112 after the announcement. It's not how they trade them, it's how they close them. So I'm more interested in how they close gold tomorrow afternoon than I am how they whip them around tomorrow morning. So that's just food for thought for those of you that are long gold, and I know some of you are. Oil market spiked higher today, back into the 50-period moving average, got rejected, and settled higher. We came back below 46, but settled at 46. We're at 46.72. on the electronic session today, right now, as we speak. Nothing to see there. This is not a bearish pattern. It still has the makings of a bullish pattern, but it would need more time to develop. And we'll see. The oil market is more likely to whip around tomorrow, also with the employment number. But if we see the market finish higher and the stock market finish higher after the jobs number tomorrow and into Tuesday, I think you could see higher prices in the oil market. And if we get up into this area, 50, 51 next week, I think that would be a nice shorting territory for what I think is coming with all the markets and after, later part of next week and beyond. Okay, so really nothing to do here. If you're long oil, you've got to be careful. If you're waiting for the short, you're waiting for a spike over 50, and really it's 51 is like my number, because it's probably not going to stop at 50. They'll probably spike it to 50, 50, 51, maybe even 51, 50. And that's at the area where, depending on how we get there, I will be looking to take a short trade in oil. And it won't be a short trade for the day. It'll be more of a longer term position trade for my concept of what I think's coming from next week forward. Okay, so it's really the bigger picture. So just to let you know that. Bonds, not much to see here either. We're just making or continuing the bearish pattern here. So some days will be up, some days will be down, some days will be flat, but there's really nothing to see here. All we're doing is moving sideways. We've moved sideways for 1, 2, 3, 4, 5, 6 days, and you're going to expect some volatility tomorrow with the employment number, and there's nothing to see here. That we're just moving sideways, and I think that's going to continue. And what I think is the likely scenario is I think you're going to see this develop. And that's, you'll find support here. You'll find support here, okay? And we'll have to see what happens. But I believe that we're going to see lower prices in the price of bonds. And what that tells me, and here's the 10-year yield, and you can see this on the flip side. You can see the bullish pattern in yields developing, right? Off of the low, we have an up move, consolidation, readying for another up move higher. Well, the opposite is going to happen in the price of bonds. And if we bring up the 30-year bond yield, okay, it's the identical pattern, no different. 10-year yield looks the same as the 30-year yield. And this is what I believe is developing. So lower bond prices coming, higher yields coming. Nothing's changed. It's just a matter of time. This is nothing other than the market consolidating for the move that's ensuing next. Okay, the dollar. The dollar came up into the 50-period moving average, and you can see the bullish pattern playing out here. I would have liked to see more days develop sideways to lower before the up move, but nevertheless, we're getting the up move off of a bullish pattern. But this isn't really enough time to actually go full bore higher in the dollar. But yet again, you're going to see the dollar also whip around tomorrow with the employment report. So we could see a down move. We could see a further up move. It's a wild card with the employment report. So that's the thing you need to be concerned with. If you're in any of these trades, you have to be aware that tomorrow morning is going to probably be a whippy market in almost every market or all markets that I've discussed tonight and more. That's just typically what happens. So you just got to be aware of it. That's all there is to see there in the dollar. We had an up day in natural gas today, and I know one of the members was short natural gas, and I told him, be aware. that natural gas whips around and we could get back into the channel here today. So I suggested, and I hope he took my advice, to at least take half off the table, have a break-even stop in. You can always get back in the trade. But natural gas is a very difficult market to trade, and I tell you that time and time again. And as you can see on the intraday market, okay, look what happens here. You just don't know. These rallies come out of nowhere, and all of a sudden, okay, you have an up move, and now you have the makings of a bullish pattern, potential for another up move. And that's why I say you've got to be careful in these markets when you have a lead in a position and you're short or long and you're in the money. You have to take some profit off the table, and you have to put a break-even stop and then just trail your stop down or up as the market moves in your favor. But here again, it's another example of the natural gas market, and this is why it's called the Widowmaker. And this is why I don't trade natural gas, folks. It's just a very, very difficult market to trade. Do I think lower prices are ahead over the longer term? Yes. But intraday, day-to-day, very, very difficult market to trade. Okay, so, and the weekly chart doesn't look any different, but the daily chart, you got back in and closed inside the channel. So while from a longer term perspective, this is certainly a bearish pattern, day to day, this market could drive you to drink. So that's really the reason why I don't trade natural gas, but I'm happy to go over the charts. Anybody that enjoys trading natural gas, I'll continue to go over the charts. I'll tell you anything you want to know. You can email me. I have no problem with it, but full disclosure, I really don't trade this market. If I trade this market twice a year, that's a lot. I almost took a trade, and you guys know, if this candle here, okay, and you remember when I was saying, if this candle here was going to get up into the top end of this channel, okay, I would have taken that trade based on my cycle work and based on price and time. But it never got there, and I never did take that trade, and it would have been a wonderful trade. I would have probably traded it all the way down here, because here's how I would have traded it. On the next day, I would have taken half my profit off the table, and I would have put a break-even stop up in this area here. And it never got back there. And I would have continued to trail the stop, and I probably wouldn't have been stopped out. There's a chance I would have been stopped out on this candle here, but if not, I would have traded it all the way down to the bottom end of this channel, and I would have gotten most of that trade. And there's a trade lesson for you. That's the way I trade. When I get a lead in a position, I take half my position off, I book the profit, I put a break-even stop, and I trail it down, and it becomes an emotionless trade, and it becomes a trade that I cannot lose money on. It's a guaranteed profit trade. It's just a matter of how much profit. And that's how I would have traded it. But nevertheless, I never got in the trade because it never got to my number. And I'm very, very particular in specifically natural gas. I only trade it once or twice a year, and that's it. I just don't love this market. But from time to time, it will give me the setup that I'm looking for, and I'll take it, but it never did. And so I'll continue to go over it for the folks that like natural gas, but just out of full disclosure, I just don't trade it. I think we're going to leave it there tonight, folks. So hopefully this is helpful. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.